Hello investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Coupa software. So Coupa reported their Q4 2022 results last night and it took investors by surprise. So the stock is down substantially after hours, and the reason for that is that everyone kind of expected this to be a high growth SaaS business. No one was really seeing this as from the angle of being a COVID beneficiary. After all, Coupa predominantly has as customers large enterprises, so it wasn't supposed to be one that was going to meaningfully decelerate. It wasn't going to be a business that's going to be maturing its growth rates. And as we go through that, you'll see that their guidance, their path to profitability is really taking a step back. And if this was this time last year, investors would have been quite happy to take on board that kind of narrative of investing for growth. But as it stands right now, everyone is kind of like, okay, this is a show me mode. You have to show me that it's worthwhile investing, and it doesn't appear to be the case. So this is the takeaway here, right? The takeaway is you shouldn't be buying this dip, and here's why. So I'm just going to jump right in, and the stock is down, I don't know, like more than 50% in the past 3 months. So this, if you include the after-hour sell-off. And back in December, I wrote about Coupa. I said, it appears as Coupa lapses very strong growth rates from last year, Q4 2022 will meaningfully struggle to suppress this time around. Presently, investors are asked to pay 14 times forward sales, which is too expensive for what's on offer. So basically, I laid out right there, and then the Q4 is going to be a struggle, and that it's going to struggle to impress investors, and that everyone was paying a premium for this, and it wasn't going to be worthwhile. I put out a sell recommendation, and the stock is down 50% because if you include the 25% after hours, it's probably down like 60% or so in the past 90 days. And yeah, so this is the thing. I'm going to echo that sentiment again. Nothing more has changed. I actually believe that this quarter right now, I had that hypothesis before in the back of Q3, but if everyone's kind of like unsure, this is the point in time that it's a thesis breaking moment. I think that investors will start to reconsider this very, very rapidly, and you're going to see. So the guidance for the guidance for fiscal 23 points to 16% year-over-year growth rates. So they've just come out of Q4, and everyone kind of thought that was just going to be a dip in time, and then everything would be re-accelerating again. And as it appears, the guidance for fiscal 23 isn't pointing towards it reigniting its growth rates anytime soon. And what's going to happen is that analysts over the next coming days, they're going to be updating their financial targets, and you're going to see analyst call after analyst call downwards revising their guidance. And you don't want to be in that situation. You want to be in a situation where you're buying something for less than it's worth, and the analysts are upwards revising their guidance. That's what you want to be. You don't want to be in a position where you kind of paid for something and you paid at a higher price, and then you kind of like you made an investment, didn't work out, but you kind of holding on tightly, and you see analysts downwards revising their guidance. I've been there many times, and it's not a pleasant situation. And in hindsight, the longer you do this, you kind of get less attached to things. You just kind of, okay, yeah, I made an investment, didn't work out. You move on. And, I think that's quite helpful. Anyway, so I don't know if you know this, but billings is a leading indicator of where revenue growth rates are going to come out, okay? So you want to see strong billings. You want to see ideally billings above the revenue growth rate guidance, and you want to see billings above by a reasonable margin. You don't need heroic margin, but you need a reasonable margin. So let me give you some context, okay? For fiscal 22, so that's the year as a whole, billings were up 33%. For Q4, billings were up 25%, okay? So there's a bit of a drop. For Q1 23, which is the next quarter, the next upcoming quarter, billings are expected to be up 17%, okay? So, it goes from 33 on average to 25 to 17. So there's a clear path here that it's decelerating the revenue, the billings growth, okay? So you don't want to be in that position. So what does Coupa actually do? So it allows enterprises to manage their spend, okay? Whether it's from procurement or finance or supply chains, it's a business spend management platform, okay? So it's just a jazzy way to say allows companies to spend, and it measures and monitors through analytics how companies spend their capital. And this is quite a space that's really fragmented, and depending on your lens, that can be either a problem or an opportunity. As it stands right now, Coupa declares that they reach less than 20% of the global 2000 companies. So it's a fragmented space, and it's never going to be a winner-take-most sector. And there's just too many alternatives. So you don't pay a premium for being a participant in a highly fragmented space. It's just not worthwhile, because they're not going to take too much of the market share. You're never going to have too much pricing power. So yeah, here's another bit of they don't give you the net retention rate, but if you look at Coupa, and they say on the call that they only reach the customers that they hold on their platform only adopt less than a fifth of their platform, and that tells you that they struggle to kind of upsell to the existing customer base. So you don't want that. You want a business that the business proposition allows for a lot of cross-selling, and because the difficulty is the first stage, which is the customer acquisition cost. After that, you want to be able to be in a business where you allow them to cross-sell into different opportunities, and that's not being offered here. Okay, so let's talk about this profitability profile. Back in December, I said, during the Q3 earnings call, management was quick to highlight to investors that Coupa had the best-in-class Rule of 40 metric. Because you remember, the Rule of 40 is how well you're balancing your revenue growth with your path to profitability. So you want to see if you're getting, let's say, 20% growth and 20% margins, that's reaching the Rule of 40. So they were talking about how they had a Rule of 40 of 67, and then they talk about, I said that, then I talked about the fact that Coupa is using the Rule of 40 on a trailing 12 months basis. So if we look ahead to Q4, even if we argue that revenue growth rates are going to soar dramatically and they end up growing by 20% year over year, it's still going to be slightly below the Rule of 40 metric. And as you know, when they reported last night, the revenues were only up 18%, so not 20 as I laid out previously. So with their non-GAAP operating margins of 14%, this means that Coupa's Rule of 40 only reaches 32%. So, when 90 days ago, Coupa was talking about best-in-class Rule of 40, and they're not reaching that right now, and the guidance for fiscal year 23 is pointing to approximately less than 4% non-GAAP operating margins. So, that's a paltry figure, and however you kind of objectively look at this, it doesn't look like the profit margins are moving in the correct direction. The other thing that I wanted to highlight is that during the earnings call, they talk about the fact that what's happening is that they're in a game of musical chairs where talent or executives are moving around all the time, and if you want to retain the talent, if you want to retain executives, you're going to have to pay them. And the problem is that everyone was quite happy to kind of give stock-based compensation, but when your stock is going into the gutter, nobody wants to get paid in what I call funny money. People want to get paid in cash or get out, and that's what's happening. So the thing I'm thinking about here, right? So Coupa has approximately, they guide for 88 million shares outstanding. That puts its market cap at approximately 5.7 billion. So that means you're paying 7 times forward sales for a business that is maturing. It doesn't make a lot of sense because there's so many businesses that are growing faster than 30% CAGR, priced at less than 5 times sales. So you have slowing growth rates, profit margins going in the wrong direction. Altogether, it doesn't make a lot of sense why to pay a premium for this stock. And that's the case that I'm making. So if in 2021 a certain bunch of rules applied, that you could have made the case that paying 7 times forward sales for a business that could or could not be growing at approximately mid-teens, it doesn't make a lot of sense right now. Okay, the market right now is like, no, you have to be worth something substantial if we're going to pay a premium, and we have to see a clear path to profitability. None of that is being offered here, and that's why I'm not investing here. And if you want to know where I am investing, don't forget to check out my marketplace. It's called Deep Value Returns. I highlight for you high quality, actionable investment insights. Check out the reviews from our platform, and I hope to see you soon. Thank you so much for listening. See you next time. Bye.